And we are live once again. Happy Wednesday and welcome to another episode of Mr. Cashflow Live. These weekly broadcasts every Wednesday afternoon that we put on are designed to help you increase your business or practice's cash flow and introduce you to some great people along the way, subject matters that can be of help to you. The recorded version of this live stream you will find on my YouTube channel. And if you'd like to be notified when we go live every Wednesday afternoon, just subscribe to the channel and click on the notification bell. As we go along this afternoon, please feel free to ask questions. We will take some time at the end if there are any questions to try and answer them. If you're watching the recorded version of this live stream, then we will get those answers back to you via email. I am happy my guest this week is Robert Taylor. He's the Director of Operations for CSSI, Cost Segregation Services, the cost segregation provider that I work with. And Robert is one of those subject matters that I rely on the intricacies of cost segregation and some of the tax laws that we deal with. Today, we're talking about the activity grouping election to avoid passive loss restrictions. I'm finding as I deal with tax professionals and building owners and real estate folks that the activity grouping election is very often missed and it's often misunderstood as well. So Robert is here with me to clear all of that up via telephone. Robert, welcome to the show.
Hey, David, thanks for having me.
My pleasure. And you've helped me out in the past, so hopefully together we can help some folks today. So let's just start out with a definition of terms. What exactly is the activity grouping election?
Sure. So this comes up in a self-rented property. And what we mean by that is someone who owns their business and they also own the building in which the business is located in. In a situation like that, any losses that you receive from the building, let's say from a cost segregation study, we are getting large depreciation deductions. Any losses from that are considered passive losses, meaning they cannot offset income you make in your business, which is active income. There is a way to convert that passive loss to a non-passive loss, and that is the grouping election. So once you elect to group those activities together, your building and your business, then those losses from the building can be converted to non-passive losses and become fully deductible.
Okay, so a passive loss due to, say, a cost segregation study is only on paper, right? That's a paper loss because of deductions that are non-cash deductions, right?
Yeah, so it is a non-cash deduction. So it's an appreciation expense. You're not actually paying anything else out. We're just allowing you to depreciate your building faster. So you're not paying any cash out. It is a non-cash expense. But if it's considered a passive loss, it can only offset any other passive income that you may have, not your active income from your everyday job.
Okay, so I guess that's the difference. What exactly is the difference between passive and active income?
Sure. So active income is income you're going to get from your normal day-to-day job. Let's say, for example, you're a dentist. So your active income is going to be from your dental practice. Any income you make in that practice is your active income because that is your active trade or business is your dental practice. Let's say, as a dentist, you've also invested in a retail strip center, let's say, completely separate from your business. It's just an investment. Any income that's generated from that retail strip center is considered passive income. Any losses generated from that retail strip center is considered a passive loss. And a passive loss is restricted to only offsetting passive income. So if you're invested in this retail strip center and it creates a big passive loss for you, you as a dentist cannot use that loss to offset your active income, which is made in your everyday job.
That's a shame, isn't it?
It
Because
is.
that would be a big tax savings for a lot of the dentists that I know and I work with. Are there any real advantages or disadvantages to self-rental?
So people self-rent really for liability purposes. Usually, and we'll go back to the dentist example, he owns his dental practice and he owns the building in which it's located in. Typically in that situation, he's going to have two separate entities. He's going to have one entity that owns his practice, his dental practice, usually referred to as an operating entity. Then he'll have a separate entity that holds just his real estate, usually referred to as a holding company or real estate entity. The reason that's done is just for liability purposes. You're separating out your biggest asset, which is your building, into a separate entity. So if anything happens, if you're in any kind of litigation, from the business, let's say, your building is protected. They'd have a hard time coming after your building because it's in a separate entity. So that's really the only reason that people set it up like that. So that's the advantage of it, is it does protect your biggest asset. The disadvantage comes if you have, you've invested this money in this big asset, but you really can't take advantage of the deductions that come from it, especially if you're getting large depreciation deductions from it. Those deductions are kind of suspended as a passive loss. Now that's, obviously, like we said before, that can be bypassed, or that passive loss can be converted to a non-passive loss if you do this grouping election.
Okay. And that's, I think you probably need to say at this point, that's not something that's going to throw up big red flags to the IRS or cause an audit. Is that right?
No, it's not. It's a common practice. It's as simple as, recording a statement on your tax return. That's really all that's necessary to do it is you attach a statement to your tax return, saying, I'm grouping these entities for these reasons, and we'll get into the reasons for grouping and what it requires to grouping in a little bit, but you'd have to just, include that statement on your tax return. There's no approval process or anything like that to do it. It's just a statement
and it's not a tax dodge. I get that question every once in a while. Is this legit? Is the IRS gonna have a problem with this? And even sometimes when I send them the IRS documentation on it, they're still not quite sure that this is something, that's totally legitimate. So I wanted to have you say it, because I think sometimes when you say it, it carries a little bit more weight than when I say it. But so let's talk a little bit about cost segregation, because if I'm that dentist and let's say I purchase a building to house my practice, why is a cost segregation study going to help me and using the election?
Right. So let's say you're a dentist and you're doing a cost segregation on a building that you own and you operate out of. So in that case, before you do the cost segregation, we're going to want to talk to you about grouping. So there are some requirements for grouping. You can't just group anything. There are some criteria you have to meet to allow your activities to be grouped. So what the IRS refers to that as is an economic unit. If the two entities and the two entities they refer to as activities. So these two activities create what's defined as an economic unit. Then you're allowed to group those activities together. And at that point, the cost segregation would be beneficial to you because the losses would be fully deductible. Now, to meet that definition, there's 5 components to that. There's 5 criteria that have to be met to meet the economic unit. There's 5 criteria total. You don't have to actually meet all 5 to meet the definition of economic unit.
Okay, so before we get into those 5 criteria, let me just say, if you've got any questions for Robert at this point, go ahead and type them into the comments or type them into the question area, and we will address those live if there are any. If not, we'll get back to you after the recorded version. So Robert, you said there are 5 criteria or qualifications for grouping. What would those be?
Sure. So the 5 criteria to meet this economic unit are, the first one is similarities and differences in the types of businesses. Obviously, in our case, back to our dentist example, obviously the 2 businesses that we're grouping together are different. One's a rental real estate business that owns his building, and one's a dental practice. So we're not going to meet that part of the economic unit definition. But remember, you don't have to meet all 5 to be considered an economic unit. The next 2 are extent of common control and extent of common ownership. So here's where you want to look at, what is the ownership structure? Who owns the practice and who owns the building? As long as there's common ownership and common control between each, you're going to meet that criteria. So if it's the same person, if one dentist owns the practice and he also owns the building, you meet that definition. Now, where you're going to get into trouble there is if you have 3 or 4 dentists that own the practice and one owns the building. In that case, you're not going to meet that criteria. In that case, you really are not going to be able to group those activities together, as long as it's common. So you could have 2 dentists that own the practice, 2 dentists that own the building. That's common control, common ownership. You're going to meet that criteria. The next is geographical location. Obviously, we're in the same place. The building houses the business, so we're going to meet that criteria.
Yeah, that one we got it made.
We got that one for sure. And the last one is interdependencies between the activities. We're going to meet that one too, because the business is dependent upon the building being there. So we're going to meet 4 out of the 5 in most cases, and that's fine. Again, you don't have to meet all 5. So as long as you meet those 4, you will be able to group those activities together. And again, that's just a statement done on the tax return. One other thing to mention is typically the grouping election has to be done in the first year the building goes into service. The reason is, if you don't group, let's say go back to the dentist example. Let's say he put his building into service in 2018, and he's been depreciating it since then, for 2 or 3 years now. By not making this election, by not putting that statement on your tax return that you're going to group these activities together, you've essentially elected not to group. And to change a grouping election, something has to happen. There has to be some kind of significant event that occurs that would cause a regrouping. And that's really going to be, change in ownership, change in location, change in business, something like that would have to occur. So 9 times out of 10, if it's a self-rented property like this and you want a group, we typically have to catch it in the first year the building's going into service.
And that's really probably the best time to do a cost segregation study anyway, right? Because you're going to get the maximum benefit that way.
Yeah, so the sooner you apply a cost segregation study, the better. That way it's just less time you're waiting to get your deductions. It's less time that you are spending depreciating the building over 39 years, and you're getting your money back very slowly. So yeah, it is better to apply the cost segregation study as soon as you can, first year being the best.
Okay, let me ask you a question because of an actual instance that happened with me. A doctor builds a building, and his practice, which he owns the LLC that's going to be on the building, he moves his practice into one half of the building, and then one half of the building he's going to rent out to another entity. Can he use grouping at all? Oh, we're getting some bad sound here.
Yes, you can. So what would happen there? And you.
How would that work? Can he can only group half?
So what would happen there? In his case, he'd really want.
Okay, I think we're starting to lose you, Robert.
Yeah, so he'd group half the building. So he would get someone. Can you hear me, David?
Yeah, you're kind of breaking up on me a little bit, in and out. Unfortunately, I think so. The idea, I believe, and you can tell me if I'm right, is he can then group the loss from the building with half of the loss of the building with his practice. The other half would have to remain passive. Is that correct?
That's correct. So in that case, you would want to separate out those 2 sides of the building. You would want to say, let's say the building is $1 million building. You want to break apart, okay, here's the cost of the suite that I occupy, because you're only going to meet that economic unit definition on the side you occupy. And that's something we could actually do through one of our studies. We could break out, okay, here's the cost of the suite you occupy. That way you have that information necessary to make that grouping election, because it would not be appropriate for you to group that entire building with your business, just the part that you occupy. And then you calculate, I'm getting my depreciation deductions from this particular side. That's the part that's going to be active and be able to offset my active income from my practice.
So even if you don't utilize the entire building, there's still an advantage to using the grouping election for the part that you do occupy. Would they split that up based on the square footage, or how would that work?
It's usually going to be a square footage. That certainly goes into it. What we would actually do, if you're doing it on your own, and you're not doing, you're obviously not having, a firm like us, go in there and identify costs for you. That'd be a good way to do it. But we, a more accurate way to do it, which we would actually do, is go in there and calculate, components. Because if you go by square footage, one guy may have, just as an example, he may have, granite countertops, and one guy may not. His price per square foot should really be a little bit higher.
So it's always wise to actually calculate everything and get an engineering-based cost segregation study done. And I would not expect a different answer. Very good. Are you still there, Robert? Are you still there, Robert?
Hey, David, I got kicked off for a second. Can you hear me?
Okay, yeah, I got you now. So if somebody wanted to use the grouping election, it is the first year of ownership of the property, and they wanted to use the grouping election, what do they have to do to do that on their tax return?
Sure. So it's just a statement that you make on your tax return. All you have to do is put a statement, and you're just going to identify, here's the two entities that are being grouped. You're going to identify the two entities, and you're going to also have to include reasonings why you can group. So really, you're going to have to include, here's why these two activities meet the definition of an economic unit. You're going to say, they're in the same location. It's got common control and ownership. The building houses the business, so they're dependent upon one another. And you're going to put down the reasonings why, it meets that definition to be grouped. Once you do that, that's all you have to do. They're still going to be separate entities. So you're not going to lose any of your protection, from a liability standpoint, which is the whole reason you have these things in separate entities to begin with. You're not going to lose that. So once you put that statement in there, that's all you have to do. Once you do that, you just simply treat the losses from the building as non-passive. Or before they were passive, you just simply treat them now as non-passive, and they will now offset any other active income that you have. So it's as simple as that. It's as simple as just making a statement.
Excellent. And do they have to do that every year on their tax return?
No, just the first year.
Just the first year. And it's assumed after that, unless they change it.
Yeah. Once you make that election, you can't change it unless something happens, unless there's
something major change.
Some event happens that would cause a regroup. And so once you do it one time, that's it. All you have to do going forward.
Okay, very good. And this is probably more about cost segregation than it is about election, but I've also heard from a number of dentists. I work with a lot of dentists and a lot of doctors nationwide who either buy an office condo or something like that. And they say, well, it's just not worth enough to do a cost segregation study on. What would you say to that? Are you there? I think we lost Robert again. So I'll say that I believe that it's worth doing a cost segregation study for any property bought or built in the last 10 to 12 years. Robert, we got you back.
David, can you hear me?
Yeah. So what I was asking and starting to answer myself, because I thought we lost you, is if somebody has a smaller property, like an office condo or that sort of thing, and they say, well, I don't know about doing a cost segregation study because the cost of the building wasn't that high, what would you say to that?
Yes, we get that quite a bit. Typically there's a lot of, information out there that the building has to be, a multi-million-dollar building to make cost segregation make sense. And that may be how it was when cost segregation first started, back in the early 2000s. But now, the processes are much more efficient, and we actually see positive ROI benefits, up to a 10-to-1 return on buildings with a cost basis as low as $300,000, especially now with 100% bonus depreciation. Any property that we're identifying with a 20-year life or less is eligible for 100% bonus depreciation, meaning you can depreciate all of that cost in year one. So it moves 100% of our benefit to the first year. So even those smaller cost basis buildings, are seeing very positive benefits in the first year. And the fee to get that study done, makes sense, even though it's a smaller building.
Very good. Very good. I would, and especially when you can apply any loss created by it to the practice as revenue, if you do it in the first year, that almost becomes a no-brainer. I'm going to issue one last call for questions because our connection is a little tenuous, and it sounds like Robert's playing the maracas. So anybody have a question? If you do, please post it right away and we'll try and answer it. And if not, then you can always reach out later with questions as well. And at this point, everybody is being shy and we're not seeing any particular questions. So with that, I'm going to thank Robert for joining me today. Robert, this was great. I hope this really benefited some folks that are considering ways to save on their taxes, especially professional people who self-rent. So thanks so much for joining me. I appreciate it very much. And you and I will be talking soon, I think.
No problem, David.
So join me next Wednesday. My guest will be Carlene Dittrich, the founder and CEO of Med Revenue Solutions. This is the live stream that we had to postpone from last week due to some technical difficulties. I think we've got those all worked out and straightened out. Please feel free to contact me if you have any questions or just enter them in on the broadcast and we'll be sure to answer them by email. So once again, join me next week for Carlene Dittrich. And as always, I'm David Weiner, known as Mr. Cashflow from Cashflow Strategies Incorporated. After all, it's your money. Keep more of it.